basically we keep pushing up the expected rate hikes. But the basic core picture is pretty much the same. Market is still expecting eventual rate cuts, eventual disinflation, a soft landing, strong earnings growth with AI helping out, and geopolitical not get exploding into something bigger than what it is. The narrative right now assumes that rate cuts are going to begin by September to December, and right now it's focusing on September after that weak NFP jobs report and the Fed being hawkish, but not so hawkish that it was talking about hikes. So they're looking at between 1 and 2 rate cuts throughout 2024, beginning late. Soft landing still without a significant deterioration in growth, still super strong earnings, about double the normal pace, with help from AI. Big caps, where about 70% of the earnings gains for the S&P are expected to come from, and then also geopolitical domestic risk remain minimal. So we've been looking at this chart for a few months. This is a chart of the NASDAQ at its all-time highs, and we've had the resistance here. It finally developed. We've had a correction off of it. Now we're trying to figure out if that correction's over. We haven't really had traditional signals yet, but this is an area that the market's been having trouble with for a long time. If we can get through this and run, then we're in a better situation for a new upswing. Still have breadth problems a bit. They have materially improved. The mid caps made basically advanced decline lines for mid caps have made new highs, along with advanced decline lines for the large caps. So that's a significant improvement in participation and breadth, but we still have laggards from small caps. And of course, most stocks in the broad market are small caps. So we still need to see that problem alleviated before we can get super excited about upside potential. IWM is just kind of in a basing mode after a false breakout. And we can see the false breakout on XVG, which is a value line, geometric, tried to break out above 610 for a week, and then boom, right back down. And now we really need to break out above this 617.50 highs that were made in that breakout attempt for us to be on the upside again. And alternatively, we've been in a range now for basically all year. If we break that range to the downside, 563.50, that would be very, very negative. TNX has been a big driver for market action. We've been talking about it for a long time. We had the breakout here that we talked about at this time in early August that led to this correction. That correction pretty much continued until we got a shift in Fed policy, led to a double top breakdown and gap down that launched this new bull leg up in October. We're going to talk about how that really ended up leading to financial conditions easing much more than would normally be the case. It's the easing that we've seen is on par with what you'd usually get having 2 rate cuts since then, and we haven't had any. So we'll talk about that more, but basically as bonds, as rates came off, that helped drive the market higher. When rates started to react, stocks were okay with it till they got to a real breakout point above this key level where they'd really taken off before, and that sort of led to this correction. Now we've had a little head and shoulder breakdown in TNX, although the bond market doesn't look quite as positive as it did at this point in time. So we really want to watch carefully. We still want to be aware. Certainly, if bonds can rally and rates can come off, that's going to be positive for the market and allow it to rally further, as long as it does not accompany slower growth outlook. Whereas if we get problems with bonds again, they get back into this range, it's going to start to be problematic. And above 4.7 would really be a spillover problem to keep your eye on. TLTs, which are the bonds. So we can see that basically we've been in a downtrend channel for this year. We kind of hit the bottom of it. We've bounced. We had some volume traction was pretty, it's pretty decent volume traction, but it's not nearly as large as we experience on the downside. So really don't watch that. And we've got some pretty big HVN on a weekly basis. Here, 91 to 93 and a downtrend channel. So there's, even though we've had a little mini head and shoulder bottom here, that the objective is kind of in the middle of this HVN. And so we really want to see if bonds can continue to move higher and break through resistance or not. Looking at the S&P, still, we have an HVN that we're kind of severely testing here, have downtrend line that we're testing. I haven't had a chance to look at the end of day data, but so far the rally really has not been on strong volume traction, nor has it showed signs of demand dominance that we normally see at the end of correction. So our correction over indicators catch about 70% of corrections and do a good job of it. The other 30%, we watch a lot of different breadth and plurality models to see if we're starting to turn, and we haven't had signals. We'll take a look at it after today, but we need stronger demand and stronger participation to really say that this is not just a rally in a correction. Remember also that about 70% of corrections have severe retests. We've had some slight retests, but this isn't, so you still have a possibility. You can retest or make new lows. And so we're basically still in correction mode. We've got some indicators that we use to tell us if we missed a correction and we have to start trying to participate in it. They haven't triggered yet. The other thing that I want to understand is kind of a big picture backdrop that you want to kind of be thinking about is that we've had really 11 rate hike campaigns since 1950 that pushed the yield curve into inversion on a broad-based basis. And by that, we mean both the 3-month over 10-year inverting and the 2-year over 10-year inverting. These other three where there was no recession, 83 and 94, we didn't get any inversions at all. And 65 to 66, we got an inversion in the 3-month versus 10-year, barely, but we didn't in the 2-year versus 10-year. So all of the tightenings that have led to yield curve inversions have had recessions following 11 out of 11 times since 1950. There's a huge lag, however, from when the Fed starts to hike and when we get a recession, and that lag averages 26 months and has varied from 11 to 42 months. So it's a huge lag. Just to give you an idea, the Fed started hiking in March of 2022. That puts May right now where we are as the average before recession starts to materialize, and we've had as long as 42. So we could be looking somewhere between now and the end of 2025 could still be validating this combination of rate hikes and inverted yield curve. As a yield curve, one of the things I want you to notice, of course, 83, no yield curve inversion, 85, no yield curve inversion. The other thing that is important to note is that this is from the Bank of International Settlements. The IMF does the same thing, so does the Fed. Basically shows that the probability of recession is highly correlated to how substantial the inversion gets. We've had the most substantial inversion since the 1970s. So on this scale, the odds are still pretty good that at some point between now and the end of 2025, we will eventually get recession. And you just want to keep that in mind. The other thing that you want to keep in mind about these tightening campaigns, especially the ones that lead to tight enough policy that you have a yield curve inversion, generally, there's really only 2 ways that they end, right? None of them have ended in inflation falling and there's a soft landing. Soft landings have happened when there wasn't a yield curve inversion, okay? So, but any of the 11 that actually had broad scale yield curve inversions, so only two ways they've ended. Those ways are that the economy starts to slow down to stall speed, and the Fed realizes that it's in danger of causing recession, and it starts to cut rates. The other is that the Fed stays tight until something breaks. And something breaks is that whatever breaks is deemed a systemic threat enough that the Fed forgets about inflation and starts focusing on fighting recession and starts cutting rates. The other thing that's important about the yield curve inversion is, and I've noted it with this blue marker, is yes, there are this huge lag, and it's like, great, 11 to 42 months, that's a hell of a lag. What does that really do for us? And it's a good point. It just tells you there's problems out there, but it doesn't really tell you how far out there. But all of these recessions happened either concurrent or within 6 months of when the yield curve uninverted. So yes, the yield curve inversion and the tightening, all those things are warnings that we're eventually likely to have recession, but the recession isn't likely to arrive until around within 6 months or so of when the yield curve uninverts. The yield curve hasn't uninverted yet. So we'll have at least 6 months, and we have a ways to go. We're not in imminent fear of recession. Now, what can cause the yield curve to uninvert? Generally, it's two things, and almost always the former. And the former is the Fed starts seeing growth slow down substantially, and it starts cutting short rates. So all of a sudden it cuts short rates, and short rates fall below long rates. The other thing that can happen is, for some reason, you have an inflation problem or something else that is pushing up long rates, and long rates rise so high that they rise above short rates. So we want to be watching for those two things to develop, because when the curve uninverts, that tells us that we're likely to get a shift in policy. All right, the other thing that is just really unique about this current situation that we have that's important to understand is this blue line is basically a line of financial easing and tightening. When it rises, financial conditions are tightening, and when it falls, financial conditions are easing. So we had a shift in October, right? We had it from August to October. We really had, that's when those TNX rates spiked. That's what led to that correction in the stock market. And what ended that, what we really had, well, what caused it is that bonds were rioting. What does that mean? That means that the bond market was not able to absorb the supply of bonds being floated by the Treasury. So they had to sell so many bonds because of huge deficits. We have record deficits in peacetime or non-recession ever in the United States, and it just keeps going. And it's an election year, so they're not going to stop it. It's going to keep going. So huge deficits, but we also have huge rollovers of the highest debt level we've ever had, 130% of GDP when you count everything, and that's not counting the unfunded liabilities from Social Security and Medicaid, which are multiples of the debt that we have. Nonetheless, that debt is really high, and in fact, it's gotten to a number of what I'll call historian benchmarks. So you look in Rogoff and Reinhardt, and they've studied for 800 years back data on fiat currencies and how they failed, right? And debt is always a problem in fiat currencies. It's why every fiat currency has failed, because it artificially encourages debt with artificial interest rates that are too low. So we have that problem too, of course, and so they've had a number of markers that 70 to 90% government debt to GDP is usually when countries get into trouble. We've long ago passed that up, and COVID broke us way through that. Then we've also this year are reaching the Niall-Ferguson benchmark, which is it starts becoming a problem that cannot be reversed when a country's interest costs exceed the amount that it spends on defense. And this year we've gotten to that level. So in other words, we're spending more on interest for past debts than we are on military. So we've got big problems with that, and that means that. And then the other problem that we have that is exacerbated, and I think it's a problem for the Treasury Secretary, is that while there's a lot of resilience in the economy because people locked in mortgages at much lower rates, so as interest rates rise, they stay in their houses, and it doesn't really affect them very much. And then businesses, we have 10 years of artificially low interest rates, near zero, right? Businesses, especially higher quality businesses, were able to lock in really long-term funding. So they don't have to refund and roll over stuff. They've got low interest rates. That leads to their ability to withstand higher interest rates better. However, the Treasury is in the opposite situation. The Treasury Secretary did not extend its average duration at all while interest rates were low for 10 years. And so we have a very low duration on our debt already. And one of the things that caused this huge easing of financial conditions, well, this is normally this much easing in financial conditions normally accompanies 2 to even 3 rate cuts. We didn't have any rate cuts. So the market eased substantially. Spreads came in, money supply grew. We're going to look at some of the components of this. But what I want people to understand, this huge rally was funded really by this huge easing of financial conditions. There's 2 policies that shifted here. One was the Federal Reserve said, okay, we're not looking to raise interest rates anymore. Now we're going to be looking for when to cut. So that was a big shift. It was what market was looking for as a pivot. And then the other huge thing that happened that allowed the long bond market to rally substantially was that Yellen heard at least some of the problems in the bond market. And so she said, okay, we're not going to float long bonds very much at all. We're going to shift to T-bills and T-notes that are very short duration. So that took the pressure off the long bond and allowed it to rally. However, what you want to understand is that didn't really fundamentally change the problem. The problem was there's too much debt for demand to pay for. And so when all you do is say, okay, we're not selling 30 years, we're not selling 10 years, we're selling 1 year, 6 months, and 3 months. Yes, the market was able to absorb that, but what that means now is it shortens the duration of the debt that the Treasury has floated, and it means they have to roll over ever more frequently. So the too much supply of debt problem was kicked down the road, not very far. And so it didn't really solve the fundamental problem, it attacked the symptom. So we've got a problem with the bond writing that have happened that we really have to pay attention to. So part of the reason for this huge easing in financial conditions that led to this great big rally in the S&P was money supply on an unseasonally adjusted broke out and went to new highs. Very strong rise in money supply. And I would suggest starting to watch this unseasonally adjusted money supply. In the 1970s, the analysts that were watching seasonally adjusted money supply couldn't figure out what was going on. And really, it was the unadjusted money supply that gave them an indication of when things were really loosening. And so we're in a similar environment. Now, we talked about this huge easing. Normally only happens with 2 or even 3 rate cuts. And what caused that? A lot of what caused that was a tightening of spreads. And so we can see that on this chart. We have the S&P here, and we have AA versus CAA spreads. We can see in October, we got a substantial tightening of spreads. Same thing with all kinds of different junk bonds, etc. We got a real tightening in spreads. That led to an easing of financial conditions all the way across the board that helped fund this big rally. Another thing we want to kind of understand here, and we talk about this in the gold workshop quite a bit for those of you that took it, but really since we made the shift to a fully fiat currency, Here's the trend of GDP growth. It's just been a disaster. GDP growth has really collapsed to very low levels from reasonably high levels since 1971 when we went fully fiat currency. And this trend continues. So we want to understand that fiat currency and all these debt problems that we're experiencing, these are all associated with the fiat currency. They're part of what creates this trend of substantially lower GDP growth on a long-term basis.